All right, recording is on. Welcome to 758 P Equity Analysis. I am Professor Joe Perfetti. I will be with you for the next 7 weeks as we go through our content in this online MBA program. Basically, what we're going to do is focus on teaching you how to start to think like a sell-side analyst and evaluate companies. And we'll be doing some real-world evaluations as we go through the material. I'll also let you know about the assignments. I'm probably going to be adjusting them week by week, just because I'd like to make everything we do pretty contemporary. So I know from the nature of the online class, for the videos, some of them might be a year old, but like, for example, homework 2 for next week on EIC, I put up the data from NVIDIA this morning so that we could, I think it's been heavily in the news recently, a lot of people talking about it, so they'd be a good company for us to analyze as we go through the semester. So just as an FYI, I'll kind of let everybody know week by week when I've adjusted some things. But again, hopefully everybody got a chance to see the syllabus. Let me just quickly go through that. Share screen. But kind of lays out what each of the themes of the weeks will be. But a couple important things. One, we're using the 7th edition of the valuation textbook. Previous editions will not help you. 7th edition was completely rewritten by McKinsey. That's really the core content for this class, and just a good book to have in general, because if you work as a practitioner in the field of valuation, you've read the book and it's on your bookshelf. In terms of the outlines of the session today, we're going to kind of go over a little bit of a kind of a core overview of some of the content that we've introduced, give some examples. Second week of the class, we'll focus on EIC, which is another way of saying that about 50% of the performance of any company is its industry. So there's a framework called EIC, Economy, Industry, Company, that we will introduce to look at that external market environment. The third week of the class, we'll get into what we'll call historical analysis. Finance is actually more forward-looking. I was going to say accountants look backwards. They're the scorekeepers of the world, and we care more about the future. Like, I don't get the cash flows you generated in 2022. I care much more about the cash flows you're going to generate in 2025. So nonetheless, we are going to look at historical analysis as a benchmark to give us a baseline of what's going on with the company. Not that the past repeats itself, but nonetheless, when we do the valuation. So let's talk about a framework to do that. The fourth week of the class and 5th week of the class, we're going to do a lot of modeling. So you're going to build a real world enterprise DCF of a company. We'll do it together in week 4 on a common company, and then I'll give you a chance to do it on another company in week 5, because you're going to build a reusable model. And then week 6 is the kind of last section of the content, which involves multiples, comparables, price to earnings, enterprise value multiples, etc. They're actually very much related to the cash flow valuations, and it's just an alternative form or shortcut of valuations. We'll talk about how to do that and analysis on that. And then week 7 will be your group project final presentations. That kind of ties right in here into the grading. So essentially 40% of your grade this semester will be a series of individual assignments week by week through week 6. You'll take a midterm exam in the middle of the semester, and there's no final exam. And then the final day of class, you'll have a group team presentation project worth 40% of your grade. So we have 19 people registered for the class. That means we're going to have 4 teams of up to 5 people. I don't know where everybody signed up, because I looked right before the class. So we're talking about the sign up in a second. But essentially, what you're going to be doing, and you can almost work it in parallel, is that each of the 4 sections of the class, EIC, historical, the model, and the multiples, you're going to do it on a company that your team will pick. So pick, I don't know, Nike, for example, Starbucks, Target, Dollar General, whoever you want to pick. That's not an assignment in the class. And again, what I'll let you do is I'll help get some of the information for you from Bloomberg. And then you'll actually do a 20-minute presentation, about 5 minutes per section, that final day of class as a group grade. And that's the group valuation project. Pause, see if any of that makes any sense. Questions about any of that? All right, I think you read the idea of, expectations. Hopefully you have some good conversations during the classes that we have. Don't violate the honor code, please. This is a kind of list of all the assignments and the due dates, which you can also find in the assignments tab. But, and again, each class will run 7 to 8:30, and then once a week. And then essentially, I will record every class as we're doing this one and post it. Actually, I like to post on YouTube because I don't know if they force you to use Panopto in the online MBA program, but Panopto absolutely sucks. It's awful software. People have trouble accessing it and using it and blah, blah, blah. So I think YouTube is pretty ubiquitous. So the videos will be recorded on Zoom. You can watch them on Zoom, but you can also watch them the following day on YouTube. So that's the syllabus. Questions about the syllabus? Okay. In terms of the materials here, yeah, Terrence?
What week is the midterm?
I want to tell you without, where did I put it? It's going to be August 8th.
August 8th. Okay, thank you.
Yep. So again, if you want to check due dates, easy, just click on assignments and all the due dates are listed at this point. And also for week 2, the assignment says that the data for week 2's assignment will be posted in the announcements. I posted that earlier today. So that's the data that you'll need for the NVIDIA assignment in week 2. All right, so for week 1, we asked you to do 2 things. 1, sign up for groups, so talk about that. And 2, do this little key value driver exercise. So let's talk about the groups. So I'm guessing, because I see people here in these project groups, that this is where you try to sign up for groups. But confusingly, I actually need you to be in groups here under project groups, because there's 4 of you. Can't have 2. So preferably now, while we're talking, before the end of the night, if you guys have already kind of pre-picked a group, just literally come here, people, project groups, and Elms, drag your name to one of these 4 teams. At the end of the session, if you're not in one of the 4 teams, then either later tonight or tomorrow morning, I'll just put you in a team. So everybody's got to be in one of those 4 teams. And if there was some confusion about where the groups are supposed to be, it's under project groups, not student groups. But
So,
you're going to be in one of these 4
Professor?
teams.
Yep.
Yeah,
It's hidden
Professor?
problem. We cannot see that.
We couldn't select the others. It's locked. We only could choose 1 or 2 at the bottom.
So
And
you
it
can't get
doesn't
in
have
any of
what
these
you're
4?
showing. No, all we see, we don't see project groups. We see groups. We see team 1, team 2, team 3, team 4, but they're all locked. And only 2 groups allowed us to select. I could see
No,
if I could
I'm
take
not.
a
This is really
screenshot.
weird. All right, so tell you what, I'm
Yeah.
going to delete the project groups.
Yeah, we cannot
Yeah.
see it.
Okay, can you see this? The student
Yes.
groups? All right,
Actually, the first one was created by me.
I'm going to do the group set. I'm just going to call those project teams. Allow self sign up. I want 4
Mhm.
per group, up to 5 people per group, and then boom. All right, tell me if you can see a new tab called, if you refresh, called project teams.
Yes.
Great. All right, so drag yourself into one of those 4 project teams. Sorry for the technical difficulties. As long as you put yourself into one of those teams tonight, I'll give you the 2 points credit on the assignment. since we messed up on that one. So there were technical issues. So easy 2 points. But that's where your team will be. And so again, the project team work, what I would say is should continue as we go through the classes, because to some degree, each one of the weeks is one of the 4 pillars of your group project presentation. So sometime next week, if you tell me as a team which company that you want to value and do your project on. So you need a publicly traded company that you're going to basically apply what we're talking about this semester to one of these teams. And so, you can do Disney, you can do a pharmaceutical company, biotech startup or biotech company like Amgen. You can do a manufacturing company, tech, whatever, as long as it's not one of the ones we're doing in class. And then that way you can kind of start working on the projects without waiting to the last week of class. Kay, I see your hand is still up. Is it KN or K?
It's KN. You're fine. I was just trying to make sure I selected the project group. So I'm good. Thank you.
Okay, great.
Mhm.
All right. Well, as we have technical difficulties, we'll get them resolved, but thanks for pointing that out. All right. So the other thing that we had on tap, go back for week 1. Was the key value driver exercise, right? So was everybody able to kind of complete the key value driver exercise? Kind of go through the spreadsheet? All right, so I want to come back to that, and I want to just kind of refresh a few things about the online videos that lead to the key value drivers. So did I put, where's the files folder? Yes, Young. Is it Young or Young?
Yeah, it's Young.
Young, okay.
Professor, in the video, you mentioned that we need to be Bloomberg certified. Does that apply for our class at all?
To be honest with you, I wish it did, but unfortunately, to be Bloomberg certified, you have to be in front of physically a Bloomberg terminal at College Park. And since this is the online MBA, you probably won't be able to do that. So the videos were actually recorded in one of my undergraduate sections. So there's some of it that won't apply. So unfortunately, the answer will be no. You don't have to be Bloomberg certified. But I will be giving you data from Bloomberg to do some of the assignments. Just looking for the files folder. Why don't I see a files folder? All right, here's what I'm gonna do. I'm gonna put a lecture note in the announcements until I can figure out what happened to the files folder. Announcement. Insert document. Upload documents. All right, so here is a PDF that we're about to go through in the announcements section. If you want to download it and have it in front of you. Publish. All right, switch to PowerPoint. Okay. Here. All right, so this was part of the online video, but the content that we use this semester is based on some of the work done by the consultancy McKinsey. McKinsey, who's in 1,000 boardrooms, has done a good job over time, which they've not only organized in the book, but in their practice, of taking what matters in the real world from academia. And they've kind of organized the things that are practical. And from a financial valuation standpoint, in the book, the basis is what they call the 4 cornerstones of value creation. Right? And these are sort of the 4 most important things from a value creation standpoint. The first cornerstone is fundamental to finance, and it's basically what I'll call spread. And it goes with the premise of, if you could borrow money at 6% from a bank and invest that money and make 4%, is that a good idea? And, if you watch the video or just think about it, it's common sense. The answer would be no. Like, it doesn't make sense to borrow at 6 if you're going to make 4 because you can't pay it back. Right. Well, in the real world, finance 101, when we say borrow at 6%, that's a cost of capital or hurdle rate. When we say earn 4%, that's an ROI or an IRR. And when your IRR is less than your R, then you have negative NPV. Okay. And essentially that's what happens in the real world as well. Like, if companies can't earn a reasonable return on investment / IRR over time that beats the hurdle rate, you can't create value, because those percentages are a proxy for cash flow. Right? If you say borrow at 6%, 6% hurdle rate, cost of capital whack, then you got to pay 6 cents per dollar back to investors per year. That's a risk adjusted number. And if you make a 4% ROI, you're generating 4 cents of cash per year, and 4 cents doesn't pay back 6. So over time, you have to have what's called a positive spread. You got to have an IRR greater than your R. You got to have an ROIC greater than your cost of capital or hurdle rate. And ROIC is just a 1-period IRR, right? But it's how we keep score. And that's very fundamental. So again, 2 things come out of that, right? The first is that growth doesn't create value. And the idea is that if I borrow at 6 and make 4 and do more of that, I just destroy value at a faster rate. And that doesn't do any good to anybody. And so the whole point is, if I can borrow at 6 and make 14%, well, heck, I want to do that all day long. And so what matters is growth relative to return, or matters specifically growth spread combination is critical. And there's good growth and there's bad growth. And it's up to leadership to determine. I'm not saying that you can't make an investment short term that doesn't pay off, but over time it's got to pay off. And that's really, really critical, right, to any business to be successful. Right? And so that is one of the fundamental parts of value creation. The other thing that comes out of this is that approximately 50% of that spread is your industry. Your industry is more important than your company to investors, or at least so says Warren Buffett. There's a lot of academic studies on this. But again, the idea is, and I'll paraphrase Mr. Buffett, Mr. Buffett, Warren Buffett, Berkshire Hathaway, I never invested in companies. I always invested in industries. Because if you fall in love with a company in a bad business, there's nothing they can do. If you take an average company, even in a great business, they can make a lot of money. So his investment philosophy over time was pick the industry that's attractive, preferably enduring, then pick the company that's going to win in that order. And that has served him well from an investment philosophy. That's kind of the approach we're taking in this class, is that we got to start with the industry, because the industry really matters, right? And I could tell you all day that there's academic data, it's in the book and everything else, that shows this 50% plus or minus a little bit, but I think it's easier to see it in action. And so what I'm going to do is switch here to a Bloomberg terminal, which, if you do have access, we have 60 of them at the University of Maryland. The large majority are in College Park. There's a teaching lab, 3505, with 32 of them. The lab downstairs, I guess, 10. But there's terminals in Shady Grove, terminals in downtown Baltimore, and terminals in downtown DC, like 1 or 2 in each of the areas. But again, you don't have to use this. But does anybody actually use Bloomberg as part of your day job? It's on this call. Had anybody used Bloomberg before? Or have a sense of what it is? Okay. Well, it's the pro tool if you work in finance. There's 340,000 users worldwide. Software now costs, I think they've raised the price to $27,000 per user per year on a subscription basis. That's the base price, goes up from there. It's expensive software. But as I said, if you work at BlackRock, you work at Goldman Sachs, T. Rowe Price, this is the software you live at every day. It's got 1.6 million companies, real-time data. It's trading systems, news information system. It's a system of record. It's got a lot of financial information, stocks, bonds, crypto, it's all in here. So somebody give me a publicly traded company, any publicly traded company.
NVIDIA.
I don't want to do NVIDIA because it's your homework assignment.
Oh,
I'm sorry?
It's the big real estate one.
Oh,
Yeah, it should be I think.
Realty Income.
Realty Income Corp, yeah.
Okay. All right. I thought you were making some kind of Orioles reference there for a second. So, all right. So here's a company called O. One of the nice features you get DES is it'll tell you who they are. So they manage a portfolio of commercial properties across the US, single tenant retail, lease to regional national chains, long-term mission groups. Okay. One of the nice features of this tool is it does real-time benchmarking. So if you're lazy, and a lot of people on Wall Street are, these would be publicly traded, probably more REITs that are close to O. Now you can customize this to your heart's content, but this is a list of default that most people would start with. So here's their peers. And it's got all these templates of already kind of predetermined information about them. But what's nice is I can kind of go over to custom and I can look up any data point that I want. So the data point that I'm going to add here is something called ROIC, return on invested capital. And the tool is going to say, which one do you want? I'm going to say latest filing. So this is either going to be through March or June of 24, depending on when they release earnings, and rolling 4 quarters. So last 12 months. So I'm going to hit enter, and the top row in white is the industry average. It's the average of all the companies on this list adjusted for size so that somebody doesn't distort it by being a tiny company with an outlier number. And then I'm going to add a column called the WACC, which is the current cost of capital for each of these companies today. Again, top row in white is the industry average, and O, which is Realty Income Corp, will be the first row down. Okay, so here's how, Yang, go ahead.
You mentioned that it's the top row on white. Is that where the cursor is right now?
Yeah, this row right here,
Okay.
that is the market cap weighted average. That's the industry average.
All right, thank you.
And then O will be this company down, and then all the companies of the scrollable list. So this is the average of all the companies on this scrollable list. Okay. So here's the point. This industry is borrowing right now at 8.39%, right? And over the last 12 months, it made 5.34. Is that good?
No.
No. That is what we would call value destruction. Okay. That would be negative NPV. Because you can't beat your cost of capital, you cannot create value. That's what we start thinking about. So this industry is destroying value. So it's just a tough industry. And the point is, look at all of these ROICs for all of these companies. There's an outlier, Simon Property Group, outlier, but most of them are not doing well. And that's the point. Industry matters, markets matter. This is, commercial real estate is a really tough environment. I mean, today, New York Times, Bloomberg had the story of this is like the next real estate crisis because basically interest rates are killing this industry, and they still haven't recovered from COVID and people staying at home. So it's not a surprise we're seeing these numbers, but that's the whole point. This is a really tough industry, and you don't see a lot of companies doing well in this industry. Markets matter. Greg or Gregory?
So yeah, question for you. So there's one here where the ROIC is actually negative
Correct. That means they're losing money.
on top of the WACC.
So ROIC is profit divided by invested capital. So if you have a, let's say, kite, the number above it, 2%, that means they're making a small profit relative to huge investment, but it's not enough to cover their hurdle rate, right? This company's literally losing money, so which is even worse. So they have a negative loss operating loss. But back to, I'll sort. Who's doing well? Simon. Simon's the only company in this industry that's beating its hurdle rate. That's it. And that's the idea. Like, I don't want to hope as an investor that I find the outlier, right? I want an industry where it's easier to make money and I can pick a couple of different companies and potentially win. Ideally, I want to find the winner, but this is not a good industry. And that's the point I want everybody to start to understand. So I saved this template because I run a part-time MBA version of this class last night, going through similar content. But I'm going to save this template so I don't have to recreate it. And I want you to give me somebody else. Let's look at another company, another industry, see how they're doing.
Tesla.
Apple?
All right, I heard Apple and then I heard Tesla. Do each. All right, so here's Apple. So this would be global tech hardware. Apple, HP, probably Samsung, Dell, going to be on this list. Probably a few others. Top row industry average. First row down, Apple. Start with, is this an attractive industry?
It is.
Why?
It's a huge positive spread.
Yes. So this is going to be very key to grading in this class. This isn't a marketing class. This is a strategy class where you just say generic things and get by. Like, this is a finance class. You got to use numbers. Okay. You don't use numbers, I'm not going to give you credit for stuff. So what you need to be saying is, it is a value creating industry because the WACC is 11% and the average ROIC, if you want to round off, is 47. Okay. Even better, the WACC is 11.22 and the ROIC is 47.49, and that positive spread makes it a value creating industry. That's the kind of interest I want to see in the homework assignments. So make sure you use numbers. Okay. But based on the nodding heads, I think everybody can see this is a terrific industry. Average company right now is probably around an 8-10% ROIC. So this is well above average for the industry. How's Apple doing?
Really well.
At scale, right? Because they're borrowing a little lower at 10.36 and they're making 57, right? And the point is, unlike O and its competitors, there's a lot of companies that are doing pretty well. Like, you don't just have to buy Apple to get a great rate of return. HP is doing pretty well. Ubiquiti is doing pretty well. Dell's actually doing reasonably well, not as well as the industry, but they're got a positive spread. Cisco, positive spread. And that's the point. Are there outliers? Yes. There's a company called Credo who is screwing this up. You know, hats off to them. Yeah, for screwing this up in such a great industry. So there's always going to be outliers.
Oh, sorry. I was going to say what's intriguing. I haven't really seen a lot of Motorola ads, but they're doing pretty well too.
Absolutely. Because right now, tech hardware is a good business. And it's easier to make money. Even if you're an average company, you can still do pretty well. And that's the point. Give me somebody else. Somebody said Tesla. You did say Tesla. Somebody do Tesla. Now, Tesla will be both Tesla, the EV makers, plus the traditional automobile makers. So it's kind of like global auto is their default list. And it'll be global. So it'll include, what is it, BSD, the Chinese firm's going to be on here, as well as, you know, Ford or GM. But Lucid's on here. Start with the top line. Industry.
Oh, wow, it's kind of close, but yeah.
Is this a value creating industry?
Yes,
Yes.
barely.
Positive
Barely,
spread.
yeah.
Barely, but it is a barely value creating industry. And part of the reason, because it's a weighted average, is Tesla brings up the weighting.
Oh,
Tesla's
because
doing
of
well.
their shares. Mm-hmm.
Now, there's a few other companies that are doing here, all non-US, by the way. But generally, Tesla at scale is doing pretty well. That kind of helps the industry average. Here's what's interesting. If I take out Tesla and the EV makers, and I just look at traditional auto, here's the traditional auto. Ford, BMW, Volvo, Kia, Toyota, Honda, you know, Daimler. How do you think that's going to look?
I think they'll, oh, hmm.
Sorry, you think what?
I was actually gonna think they were gonna have a higher ROC than WAC for the international developers and not American. I was just thinking since with our interest rates being so high, I don't think our ROCs would have been favor. That's what I was thinking. So I
Yeah.
think it'll be higher. They'll make it better profits on their end.
But the point here is it's a really tough industry. And
Mhm.
part of it is two reasons. One is they're all spending billions of dollars for electric vehicles you haven't bought yet. And two, they're still having some supply chain disruptions coming out of COVID. They're still having supply chain issues. So the point of the story is this is a tough industry and a lot of companies are really struggling. Is anybody doing well? I'll sort.
Ferrari
Okay. Ferrari
and Kia.
and Kia is not
Oh, not Kia, not Kia. Mhm.
who kind of eking out a slightly positive spread as is Volvo, but that's it. And by the way, Ferrari, 50% of Ferrari's profits now come from clothing. Ferrari is as much a lifestyle brand as they are a high-end automobile maker. And that's been intentional, by the way. So the point of the story is, okay, Ferrari's an outlier, but that's the point. They're an outlier. This is a really tough business, right? Industry matters. Talk about your homework assignment. I'm not going to make any comments about this other than to show you semiconductors, which is your week 2 homework assignment. And you have a copy of the screenshot that I posted this morning. But think about whether or not this is an attractive industry and think about how NVIDIA is performing. And one of the definitions that I talked about in the video is in this class, we have a specific definition of competitive advantage that says outperform. Okay. So everybody thinks they're good at something, right? But if you're really good at something, you should be better than average, right? And so that's the point. Your spread has to be better than the industry average spread to demonstrate competitive advantage. Okay. That's the way we should be interpreting this. And one of the interpretations that you're going to have is this an attractive industry? Don't answer. And number 2, does NVIDIA have competitive advantage using that definition? Don't answer, because that's part of your homework assignment. But that's the way I want you to start thinking about this as we go through not just this assignment, but through the world and the class. I saw Young.
Thank you. Can we take a look at TSMC?
Yes, we can. Let's see if I can get to Taiwan one. So this will probably be foundries and other outsourced chip manufacturers probably on this list, if I had to guess. Default list. So is this an attractive industry? Yes, even though the WACC is high at 17, the ROIC is still 26. TSMC is ironically, despite the 18% ROIC, they're not creating value because their cost of capital is really high right now. And at the same time, their spread would be less than the industry average. Yeah, Gregory?
In our analysis, so there's this thing that talks about market cap, which I'm assuming is like how big they are.
Price per share times shares outstanding. That's the market cap.
Are you going to want us to be including that in our analysis as to why that's driving the industry?
Well, what I want you to, when you do the analysis for the industry, is start with the industry. Like, let's look at that top row, right? And then, because that's the average of everybody on there, adjusted by size, just by market cap. But that's the average of all the companies. Like, why is this an attractive industry? That's going to be an important part of EIC when we get back to it. That's going to be key to your analysis. Patrick? Patrick, you have your hand up? Are you there or frozen? Patrick? All right, KN.
Yes, I wanted to see something. Can we look at Freddie Mac?
What's it? What's the other ticker?
Let me see.
Is that the,
Wanted to-
that's this one, Federal Home Loan Mortgage? That's Argentina.
Yes, yes. Not the art. Is it the Argent? I was thinking the American one.
Yeah, I was gonna say.
Oh, that one is top. Yes, there it is. That yeah, there it is. It's FMCC. Yeah. I'm just curious.
But the point is, and we could play this game all day, is what I want you to be thinking about is the following, right? When you're investing, you want to start with where it's easier to make money. You don't want to go where it's harder to make money, right? And again, you want to pick who's going to win. That's the philosophy over time, but we still got to evaluate things. But even internally, like when we're allocating funds, think about this as like departments. If my department looks like this, right, in terms of its performance, like don't expect in the budget season that people are going to want to give you more money, right? Whereas if the budget looks like semiconductors in the area that you're in, then you probably already know that you're getting money before you even make the request, because it's just such an easier business to do well in, because that external market, that environment, even internal environment, matters to how we think about the performance, because this is how we're going to keep score. That's the key to the first cornerstone. Okay. Second cornerstone is about cash, not income, because we care about time, value, and money. Third cornerstone, it's about the future, not the past, that's the point here. This is a magic trick, right? As much as we've been having fun playing with this for the last 20 minutes, I've tricked you, because this isn't value creation. This is accounting. We're looking at last year. And to be honest with you, who cares? I don't get the cash that Freddie Mac generated in 2023 or early part of 2024. As I said, I care more about the cash they're going to generate in 2025. And so we got to be very careful, because as I say, you can't drive a car and look in the rearview mirror. And this is accounting. Accounting is about what happened, right? Finance is about you're worth the sum of your future cash flows, right? I don't know what they're going to be with certainty, but I guess what they're going to be. And that's going to be what the values of companies are based on. You're not valued based on what you did. You're valued based on what you're going to do. That's what the whole expectation cornerstone is about. It's actually why Bloomberg is a powerful tool, because it gives you a sense of the future, right? And just as a quick example. So I've been using this one, which is a company called AbbVie, pharmaceutical company. And 2 years ago, outside of COVID, they had the best-selling drug in the world. It's called Humira, anti-inflammatory. A lot of people take it, right? And that drug alone in 2022, this is a forecast for Humira and actual. This is 2022. Move it over a few columns. 2023 and then 24 and on are the forecasts today. But in 2022, Humira sold $21 billion worth of product, just that one drug. AbbVie as a company had $58 billion worth of sales. That's actual. And this is at a 90% plus gross margin. 2023, the drug sales fell to 14 billion. By 2027, Humira sales are expected to be 4.7 billion. Why do you think the sales of this drug are plummeting so much? Why are they going down?
Is it because they're getting away from COVID a little? Is that why?
This isn't a
No.
COVID drug. This is an anti-inflammatory. Has nothing to do with it. Yeah, Jin Lee.
Competitors, they're coming up with
Why
probably
are
some similar
competitors
products.
Why are competitors important now? Why weren't they important in 2022?
The patent expired at 22?
Exactly. You can see that the patent expired, and in pharmaceutical industry, when the patent expires, your sales go down. So what I'm telling you is, do you think the market cares about 21 billion of sales or even 14 billion this year? They're fretting about, what are you going to do when your sales for this drug go down to 5 billion? That's the conversation. right? Because at 5 billion, this is a 30% gross margin. At 21 billion, that was a 90% gross margin. This is the source of almost all their profits. Now it's going away. So this is much more important to the value of AbbVie than what they did in the past. Now, one of the answers AbbVie has is a drug called Skyrizi. I don't know what it does, but I see commercials for it everywhere. So that's the point. Last year, Skyrizi, 7.8 billion. By 2027, 17.2. So in a way, Skyrizi is replacing the lost sales for Humira, and this is a very important drug to AbbVie's valuation, as is something called Rinvoq, right? So this is the story of AbbVie right here, in terms of trying to think about the value of the company. And by right here, I'm talking about 2027. I'm not talking about 2022. Nobody cares about the past anymore. So yes, we like to keep score. All right. Yes, we have all these financial statements of historical results, and we spend a lot of time on that. We pay bonuses based on that, but that doesn't have anything to do with value. Value is based on the future cash flows. That's the orientation I want you to have. But the other thing about the future is the script is not 100% written. There's risk in these cash flows. Okay. They're not guaranteed. And that's what we also have to understand. Yes. Young?
These are future projections. What do they base that on? And who does the research for that?
So, quick divergence. On Wall Street, there's a group of people called the buy side, and there's a group of people called the sell side. Does anybody know the difference? Buy side, sell side. Gregory?
Buy side's trying to buy and hope that the investment will appreciate, and sell side is the opposite. They're trying to get it now and sell it, kind of hoping that the company does poorly.
Half of it. That is the buy side. Buy side are basically people who literally buy and own the stocks for dividends and price appreciation. They're the shareholders. And one of the things Bloomberg does is it tracks institutional shareholders. So for AbbVie, 75.22% of their shareholders are on this scrollable list. Okay. So right now, this is the buy side. AbbVie's biggest shareholder is Vanguard, who owns 170 million shares, which represents 9.65% of the company. Their second biggest shareholder is BlackRock, 8% of the company, Capital Group, 5% of the company. Their top three shareholders, 10, 18, 23% of the company, almost a quarter of the company, are those three institutions, right? And that's pretty common now, right? Because we put our money in the mutual funds and the private equity insurance companies, and they're buying to get, investments. And so these are the big ones. By the way, FMR down here is Fidelity, right, which owns about 0.7% of AbbVie. But the idea is these people are very important because they're the price setters. Look at the shares that they're trading. They're not selling like 3 shares on Robinhood. Nobody cares about that. Right. And when Vanguard buys almost 10 million shares, like that sets the price. Right. These are the price setters. They're also the people that vote on the boards of directors. So they're really, really important to companies. Okay. And this is called the buy side. Right. But there's another group of people who are also important called the sell side. Right. And what the sell side does is that, let's say I work at BlackRock and I manage an active fund, right? And I have $10 billion and I have 50 companies because I got to have a diverse portfolio in a lot of different industries. Okay, so that's my active fund. How do I keep track as the fund manager of 50 companies in lots of different industries and all their competitors and all their markets on a daily basis? And the short answer is they can't. Like, too much going on. So what they do is they hire specialists, and Wall Street pays $4 billion a year from the buy side to these specialists and the sell side to tell them what to do with the stocks. So they're the consigliere to the buy side, and they work for the banks. And specifically for AbbVie, it's these people. It's Evan Seeger at BMO, Carter Gould at Barclays, Louise Chen at Cantor Fitzgerald, Terrence Flynn at Morgan Stanley, Peter Verdult at Citi, Chris Schott at JP Morgan, Chris Shibutani at Goldman Sachs. So these are the analysts who, by the way, are unmuted whenever a company has a conference call. These are the people asking the questions that basically BlackRock, hire, I don't know, Carter Gould of Barclays to tell me what to do with that, right? And he says, buy, sell, hold opinions are right here. This is real time. Overweight's another word for buy. He says buy. And so if he says buy, then I actually buy. Okay. And if he's wrong, I fire him and I'll go hire one of the other people. But these are the specialists, right? And they do two major things. One, they write the buy, sell, hold opinions. As of this morning, 20 of these people call AbbVie a buy. Buy is worth 5 points. 10 of these people call AbbVie a hold. Holds are worth 3 points. None say sell. None say get out. That's 1 point. On a 5-point scale, they're a 4.33 out of 5. So they're pretty bullish as a group on AbbVie's future, right? Now, the other thing they do is they estimate what the share price is going to be in the next 12 months. It's called a target share price. Now, there's a little bit of differentiation. Like here, Redburn thinks 203, Barclays thinks 187, Berenberg says 170. They all put their guesses in. Some of these guesses are pretty recent. Like Barclays put their guess in on July 10th. What's today? Isn't today July 10th?
July 10th, yeah.
This morning. Okay, so these people put them in this morning. And he said this morning, 187. What Bloomberg does is it averages all these guesses, wisdom of the crowd. The average guess is 184. Today, AbbVie closed at 168. What this group is saying, 9.5% upside. So last 12 months through this morning, it's gone up 30%, had a good run. They expect another 9.5%, 10% over the next 12 months. That's what Wall Street's saying about AbbVie today. Okay, that's not saying they're right. It's guesses about the future. But let's just talk about Barclays. Here's Carter. So he has a team that's covering 19 companies. That's a big team. Most Wall Street analysts do 10 to 15. Okay, they self-select who they're going to write the research on. Team is usually 3 people. It'll be Carter, it'll be an MBA in finance and an undergrad in finance. Okay, and they might also have somebody who's like a dual major, like finance engineer. Because if I'm going to do biotech, I want somebody who actually understands healthcare and the science around it. But that being said, these are the companies that they're covering and writing research on. And this is Carter. Let's see him. Doesn't have his picture, but I can tell you he works in New York on 7th Avenue. That's his email. That's his phone number. And that yellow dot means he's logged into Bloomberg, but he's away from his terminal. And we can IM him. And because this is the system of record, he will answer. And then when he finds out, like, we're just a bunch of yokel university people, he'll block us. But nonetheless, you'll at least get him to talk to you the first time because they're trained. Talk to people on Bloomberg because it might be a broker dealer or somebody else. But again, you can see his background. He's got a degree from Hopkins in chemistry and Chicago chemistry. So he's a tech guy covering this for Wall Street. You want him to understand it if you do tech firms. But that's the point. They're writing research. And if I click here, here is all of Barclays' research on AbbVie. And so I can read his reports. Now, it just so happens that they sell this and Maryland gets access to a few of the firms. Barclays is one of them. JP Morgan's another. And I can read his research, okay? His buy, sell, holds and his explanations for why you do this. A lot of what you're doing in this class this semester. The other thing that his team does is they model in Excel financials. And they upload all of their Excel files to Bloomberg for sale. So if you look over here on the right, you'll notice all these broker data being loaded. They're going to be locked. Right? Because you got to pay for them. Right? It's not free. But what they do, what Bloomberg does, takes all these locked models and it averages all their guesses. And so this is the average of all the models, the 30 models that have been uploaded to Bloomberg are averaged by row. And so basically that becomes what's known as the consensus estimate. So this revenue forecast in 2025 is the average of the guesses of all the analysts, right? So I'm going to summarize this. And by the way, when they forecast a pharmaceutical company, they're forecasting by all of their drugs. Like they don't do top line revenue because you're the sum of the drugs. here's the forecast for all of their drugs in all of their regions with all of their margins. That's what they do, right? That's not saying they're always right, but they also include their pipeline. And so this is all being forecast and summarized here, but this is called the consensus. So when a company reports its earnings and it says you missed or met the earnings, this is what everybody's checking because it's the average of the guesses of the sell-siders, right? And so this is the baseline for the valuation because this is the forecast for AbbVie's revenue. This is the forecast on average for AbbVie's EBITDA, and this is the forecast for AbbVie's free cash flow. I take that free cash flow, I discount it, I get $168 share price, right? Plus or minus. So that's what they do. And that's what you're going to be doing. Okay. And this is the third cornerstone. Does that make sense? Questions? All right. By the way, just to show you something, I happen to have the UBS model from April for Verizon that they sell. And this is, can't share it with you directly, but I'll at least pop it up just to show you an example of what I'm talking about. Like these are the models, think Verizon, if you've heard of Verizon, like this is their model, historical and forecast for Verizon of all of their income statement data, all of their wireless, which one of their parts of their business, all of Verizon's consumer business and all their business to business sales. Here's Verizon's forecasted balance sheet and cash flow that comes out of those income statements and balance sheets. Here's all the debt payments they owe based on all the debt that they have. Here's the guidance the company's been giving. And here is the valuation model that comes out of those forecasted cash flows. Okay. In a way, this is the model you're going to build a more simplified version of this because you're not going to have enough detail to forecast by product, by region, which is what the analysts actually do. But we're still going to forecast the concept. And that's part of what we're going to work on over the weeks, I think 4 and 5 this semester. But again, giving a sense of how the sausage is made. And then the fourth cornerstone is competitive advantage. Right now, behind the cornerstones, you got to have one. And by the way, competitive advantage is transient because whatever it is, it's going to go away. Right. And so do you have one? How long? And do you have a what's next? Okay. So behind all of the drivers is the math. And the math is what we call the key value drivers, or KVD for short, right? And it's summarized on this page, right? But what I asked you to do as part of your first week homework is to do the key value driver spreadsheet to understand the scenarios, okay? How do these drivers relate to value? And more importantly, what are what I would call the 5 scenarios? Because if you understand the scenarios, you understand sort of 90% of what's going to happen when you see a news article, a decision made, some results for a company, because they're going to play into one of the scenarios with the key value drivers, because that's what actually drives real world valuation. So let's go back to the key value drivers model that you did your assignment on, and then you tell me. Okay, here it is. Share Zoom. All right. So when you went through the exercise for key value drivers, first thing I had you do was start to change the profit. What happened to the value and the PE multiple when you changed the profit? Did anything change?
The value changed. The multiples stayed the same.
Okay. So if I double the profit, I double the value. If I triple the profit, I triple the value. but the PE doesn't change. Okay, does anybody know why?
The profit is a constant multiplier, so it stays out of it. And ultimately, you're doing a PE ratio, and you're, it cancels out for that.
Okay, all
equation.
right, Craig, you want to add to that?
Just because the ROIC and the WACC are even.
Well,
So
that's
there's
not,
no
the
profit
value's
spread.
still changing. Like even for company A, the more profit I make, the more the value changes. Because the value changes, but not the PE.
You need more investment to boost the profit.
So the way I want you guys to think about this is what I call sizing, right? One way to make more value is just become bigger. You just generate more absolute amounts of cash. All right. But you're not better, right? Better means something changed about your business long term, right? Bigger means same business model, just make more through the same business model. Okay. So to be better, what's going to drive the multiples are these are what are called the key value drivers: the growth, the return, and the risk, the cost of capital, growth, spread. Multiples are just an expression of future growth and spread. That's all they are. Okay. But that's the idea of better, right? So that was where we get into the scenarios. In fact, I can make my profit $1 and it's not going to change the multiple, right? It changes the value. I'm just a smaller company, not worth as much, right? So resetting. The second thing I had you do in the key value drivers is start to change the long-term growth rate. Okay. So what happens when growth goes from 5% a year to 6% a year? And by the way, just so you're clear, we will often in finance assume growth in sales and growth in profits are the same as long as the margins stay constant. So if margins are constant, growth in sales and growth in profits are interchangeable. Okay. If productivity, which means level of investment, stays constant, then growth in cash flow is also the same as growth in profit and growth in sales. So that's a shortcut that we will often use, but it has an assumption behind it of constant margins. Okay. So 6% growth at constant margins, sales grow 6% a year, profits grow 6% a year forever. So instead of profit being 100, 105, 110, profits now 100, 106, 112. What happened to the value? What happened to the PE?
Stays constant.
Stays constant. All right, Craig, now why?
It's because the ROIC and the WACC are even. There's no positive spread.
Exactly. And if you have no positive spread, you have zero NPV. And if you just grow a bunch of zero NPVs, you end up with zero NPV. And that's what you're seeing here mathematically. Versus B, 6, 7, 8. Borrow 10, make 20. The faster I grow it, it becomes exponential. So company A, I call the treadmill, right? You run really fast, you don't go anywhere, and eventually you get tired, right? Because you're not really creating any value. B is what we're all searching for, right? That's NVIDIA, right? I basically earn a positive spread and I grow it, and that's true value creation. That's what we're all searching for. Those are the stars of the business using BCG language, okay? And so that's the two scenarios. And that's why I say growth is the accelerant here. If you grow a treadmill, you don't go anywhere. If you grow a star, well, that becomes one of the most valuable companies. So we're always looking for those types of investments to make. That's where the long-term value is really created. Scenario number 3 that you did in your key value drivers, we all mature. Okay. So what happens when we mature and the growth starts to slow? So yeah, we maintain our margins and our returns, but we don't have as much growth. Growth goes to 5%. Growth goes to 3%. What's happening here?
It's decreasing.
Yeah, not only the value is decreasing, but the multiple is decreasing. This is the expectation cornerstone at work. I price you as if you're making 20 cents a year and you grow 20 cents at an 8% rate. I realize I was too optimistic because you're going to make 20 cents, but it's only going to grow at a 3% rate. Well, 20 cents growing at 3% a year is worth less than 20 cents growing at 8% a year. Multiples come down, values compress. And that is natural for companies. Like I heard, there's an article today, I was reading, this is in the Wall Street Journal. They were complaining about Google because Google's calling off some acquisition. And they said, well, Google's growth rate isn't 20% anymore, 15% anymore. Well, when you become a $200 billion company, it gets really hard to grow at 20%. That's like 40 billion a year, right? So what I'm saying is, it's not that companies that slow down are always bad. It's a law of large number effect. But the point is, when your growth slows, your multiple is going to compress and your value is going to start to come down. You become more mature. Those are called cash cows in BCG language, right? That's scenario number 3. And then scenario number 4 is what happens when your business is just negative spread. You're not creating value. And what happens when you grow that? Faster you grow, what happens? What happens when I hit 6?
Value destruction.
Is value.
Yeah.
Mhm.
The faster you grow, the faster you destroy it. So how do you actually create value in this situation? Let's say you can't get the ROIC up. You're just too tough at a business. What could you do as a leader?
Reduce your cost of capital hurdle.
That's hard.
No?
Tough
Shrink
in the
your
context of growth.
shrink your
Stop growing.
Yeah.
Go from 7% growth to 3% growth to 0% growth to negative 3% growth, because that's the point. Like, avoid the black hole. Like, stop flushing money down the toilet. This isn't helping anybody here, right? Exit the business, sell the business, shut down the business, do a layoff, right size, downsize, take cash away, give it to the other pieces that have a chance of creating value. Now, I'm not saying that you do this just because a business goes negative for 1 year, right? Now, if it has a prospect to turn it around, that's one thing. But if it's consistently a bad business that doesn't make money for a long period of time, that's value destruction. And that's not something as leaders we want to put our money into. And what I'm telling you is that we're going to be running across, not only in this class, but in the real world, these 4 scenarios pretty consistently. And you just think about what's going to happen. Am I facing a company that's in a treadmill where they're basically breaking even on their cost of capital and growth isn't going to matter? Do I have that high growth, high return business? That's the one that's going to be very valuable, probably have very high multiples. Am I dealing with a maturing business where the growth is starting to slow and the returns are potentially coming down and the multiples and the value is going to start to struggle? Or am I dealing with just a black hole where people are just throwing money away, right? That's the business that you got to really be careful about. Yes, Young?
Yeah, for giggles, I put in negative 10,000 or something, and the value continued to approach approximately 1 over ROIC.
Well,
And
just remember that you're dealing with perpetuities here. So because you're dealing with a forever cash flow, which is what this model represents, then there are some math limitations. So for example, G can never be higher than your cost of capital. Okay, so that's just a limitation of perpetuity. Okay, so can't have a G higher than your cost of capital. That's just one, right?
right. So
You can't have a negative 10,000 growth rate, because if you had a negative 10,000 growth rate, then the company would be gone in 1 year.
So if you're selling it immediately when you have, a situation like this, then you would be capturing 1 over ROIC. Would that be like the fair expectation?
To some degree, but growth still plays a role into this. And that was the other piece of the online training. But I want to highlight 2 other things and then move on in the interest of time. But one I wanted to highlight is, just think of it this way. ROIC is a proxy for free cash flow, right? Something we talked about in the online module, right? So here's the idea. If growth is the same, then ROIC is the value. So for example, if you make a 10% ROIC, then you're generating 10 cents of cash per year. And if you make a 20% ROIC, then you're generating 20 cents of cash per year. And over time, if I keep making 10 cents and somebody else keeps making 20, then the company making 20 cents a year will be more valuable. Okay, so ROIC equals free cash flow, and a higher ROIC, higher free cash flow will lead to more value at the same level of growth. What becomes tricky in the real world is growth is not the same. What I mean by that, let's say I have a 20% ROIC and I grow that at 2% a year. So start with 20 cents and multiply by 1.02. And I have a 10% ROIC, but I grow that at 10% a year, equals 0.1 times 1.1. Over time, the company that has 10 cents growing at 10% a year will eventually, starting about year 11, 10, 11, whatever that is, yeah, somewhere in that range, is going to actually generate more cash than the company making 20% growing 2% a year, and will become more valuable. And so that's the whole point. In the real world, companies are just that. This is the key value drivers. Tell me what your return is, tell me how fast you grow it, and tell me your discount rate. And if I know those three things, I know the value of anything. Okay. So last night, I wanted to show them NVIDIA, which was your homework assignment. This is using the key value drivers formula, NVIDIA share price yesterday. So here's the idea. NVIDIA, we use the key value driver formula, profit, growth, return investment, and cost of capital. And this is the fourth section of our class when we get to multiples. But so I'm doing a little bit of a sleight of hand here. But what I'm showing you is you can take the exact same formula for key value drivers and plug in just equity values. So expected profit becomes expected net income. Expected growth is growth in the net income. ROIC becomes return on equity, and the discount rate, the WACC, becomes the cost of equity. So if I just did share price, which is just an equity value, I can use the exact same key value driver formula and come up with an actual PE. So this is NVIDIA's expected net income in 2025, 91 billion. This is NVIDIA's expected return on equity long-term, about 30%. This is their cost of equity yesterday, 13.3%. This is their long-term growth rate, 11.6%. When you put these four values into our key value driver equation, it says NVIDIA would be worth $3.3 trillion and they would trade at a PE of 36, right? Right now, NVIDIA today, this is one day later, is their market cap, share price times shares outstanding, 3.3 trillion today. Their PE today, based on next year's earnings, keyboard trouble. Their price to earnings multiple based on next year's earnings, PE 36.42. So the point is, and I know I'm going very fast here, but what you're going to learn in this class, and there'll be assignments on this, is that these key value drivers actually explain what you see in the real world. All right. If for no other reason, then this is what we were all taught in business school. So regardless, this is how we value companies on a cash flow basis. All right. It's all cash flow valuation. Questions, comments, concerns, crippling fears? Gregory?
Sorry, but so just looking at what you're showing here, it looks like their estimates here, it's like 40. Oh no, wherever you were, their estimate was 46 for the next 4 quarters, but in 2027, that's like a pretty large drop off.
Because
yeah,
watch, you see how this PE based on year goes down? Think about the key value driver exercise. And what did I say? What happens if the growth rate comes down? What happens when the growth rate comes down? Gregory?
The values will also come down.
And the multiples will compress. Watch what happens to NVIDIA's growth rate. 97%, 36%, 16%, 10%. As you go out in the future and these growth rates come down, the PE start to come down. That's what should happen. In fact, that's what naive people don't realize. Because what naive people will say is, oh, they're trading at 46 times earnings. Well, they'll do even worse. They traded at 75 times last year's earnings, so that $1 of earnings will increase the share price by $75 next year. No, it won't. $1 of earnings will increase it by $49 next year, not 75, because we care about the future, not the past. Okay. And this is what the key value drivers help you start to understand. Okay. Because the growth rate is going to be less, and a lower growth is going to lead to a lower multiple. Okay. So they kept growing 125%. Sure, they trade at 75 times earnings, but they're not going to grow at 125%. In fact, that's the other thing. What's going on with NVIDIA? How do you explain the $3 trillion valuation? You can't explain it with historical data. You just can't. Right? This is NVIDIA last year, 60 billion. This is NVIDIA's profit last year, 33 billion. How does 33 billion of pre-tax profit justify a $3 trillion valuation? Like, it just doesn't make sense. By 2028, NVIDIA is expected to have 210 billion of revenue and 108 billion of pre-tax profit. Well, 108 billion of pre-tax profit on $3 trillion is a multiple of 30. I'm not saying 30 is not high, but 30 doesn't sound crazy, right? This is how today Wall Street is valuing NVIDIA. They're not valuing them on what they did. They're valuing them on what they're expected to do. Now, part of your EIC is to figure out, can they really pull this off? Is the market good enough? Is their ability to maintain their advantage good enough? Because if it's not, you don't want to be owning NVIDIA, because that share price is based on them hitting these targets. And if they can't hit those targets, they're not worth 3.3 trillion anymore. So that's the fun of this, is trying to figure that out, right? But nonetheless, you're worth the sum of your future cash flows. That's key value drivers in action. Young?
So the G figure that we're using for NVIDIA growth, that's based on some soft research that they're doing, by observing the company and the current trend.
We'll talk about how to estimate G in week 3 of the class. But the whole point is that this is a long-term G that I'm using in the model here, meaning think of it as a 30-year growth rate, not a 5-year growth rate or a 1-year growth rate, because that's the whole point. We have to value a company forever, long-term, very long-term. So that's why we use perpetuities, right? Because perpetual cash flow, long-term cash flow. Now, practically, you do a DCF after year 30, nobody cares. It's so trivial. But I'm saying that's why it's a 30-year growth rate. It's not a 1-year growth rate. So it's a very long-term growth rate. Now, what we're balancing is they got a few years where they're going to triple in size, and then they're going to start to mature. So that's kind of averaging out to about the 10, 11%. That's what the market's saying today. Right? But that's going to adjust as new information comes out, and then the share price and the multiples will adjust. All right. The other thing I wanted to briefly highlight is EIC. I believe there was a video last week about EIC, or is that in next week's class? I don't remember. Did you do EIC video last week? All right, then you're going to see a video next week in this coming for week 2 for EIC, which is your assignment. So very quickly to preview what's going to be in the video. Sure. EIC is a framework. So this is kind of the first section of the class. It stands for Economy, Industry, Company. And it goes back to what I showed you at the beginning of the class in Bloomberg. If the external market is critical to the performance of an industry and a company, then we need a framework to think about the external market. All right. And that's the EIC. And so the first part is the E. How does the economy and the macroeconomic environment affect a company or an industry. Okay. And so just give you a simple example. If you deal with airlines, 20 to 25% of the average airline's cost is fuel. All right. So if a quarter of your cost is fuel, then the price of oil is really important. Right. And when oil prices are 90, it's really hard for airlines to make money. When oil prices are 60, it's much easier for airlines to make money. So you can actually track the performance of the airline industry directly to the price of oil, right? And that's going to affect their share prices because the macroeconomic environment is going to have a very big impact on them. Costco is probably not going to be as impacted by the price of it, right? So some industries are going to have some different factors, but nonetheless, all industries are still going to be subject to some level of economic factors. And that's the part of the E. What's happening to the market, the economy, and how much does that affect the industries and companies we're evaluating? That's the premise of economic analysis. And you'll be going through the video to learn about that. The second part of it is the industry analysis. Okay. And so it's just how attractive is an industry? And you saw visually, some industries are more or less attractive. Some industries create value, some industries don't. Auto's destroying value. What's the FMCs? What was it called? The mortgage-backed companies. What was that company we looked at? FMC?
Oh, Freddie Mac.
Freddie Mac. That industry sucks.
It does.
You don't want to be out there giving mortgages right now. But the point is, that's the idea of industry analysis. We're defining industry attractiveness as a positive spread, but the key here is explain it. Why does the industry have a positive or negative spread? Well, that goes back to a guy named Michael Porter in 1984. He wrote a book called Competitive Advantage, and one of the things he talked about in the book is there's a model called the 5 forces model, which you should all hopefully be familiar with, that explains the ability to make a return. And so he also defined competitive advantage, right? And competitive advantage, he said at the time, was either you have a lower cost leadership, or you're unique or different in any way, differentiation. But you got to have some advantage, which is evolved in what's called the moat theory. You got to have a moat around your castle. What's your moat? Okay, patent, brand, cost, regulation, something that allows you to earn outsized rates of return. And so again, in this class, we're going to say outperforming your industry is the definition of competitive advantage that we're going to use. So here's the point. Part of your assignment for NVIDIA and semiconductors is the E, figuring out how sensitive the semiconductor industry and NVIDIA is to the economy. That's your first question in your assignment. Your second question in your assignment is explain the spread of the semiconductor industries using the 5 forces. 5 forces: buyer power, supplier power, rivalry, barriers to entry and exit, substitutes. So using those 5 forces, why does the industry have the spread that it does? Knowing that those 5 forces don't have to have equal weight. Some forces could be more important than others, and that's something that you're going to be talking about. But more importantly, what's going to happen to the spread in 5 years? Is the semiconductor industry going to have the same spread in 5 years? Is it going to go down? Is it going to go up? Well, that's going to mean that the forces will change. So the way we're going to think about 5 years is what happens to the forces. Because if the forces stay about the same, then the spread should be about the same. If the forces get more favorable, the spread should go up. And if the forces get more unfavorable, then the spread should go down. That's what you're going to be addressing in your paper. The final part is C, competitive advantage. Do you have one? Right? I don't think I'm going to spoil anything. NVIDIA likely has one. You saw the data. Why? And same thing. Are they going to have the same competitive advantage in 5 years? Right? Because if they're not, then their spread's going to go down relative to the industry. So that's your paper. That's next week's assignment that you're going to have to analyze. To help you do that, this is what I gave you today. In Elms, under the announcements, This is the week 2 data. All right. This is the beta to help you with the industry analysis. This is the spread, which is the screenshot I showed you earlier. There's the screenshot of the semiconductor industry. And I gave you 3 other pieces of information. I gave you a JP Morgan analyst report on the sell-siders because they're trying to do the same thing we are, right? And from Bloomberg, I also gave you an industry report and a company report. So what Bloomberg does as a feature, and they call it BICO, is it's Bloomberg Bloomberg intelligence on a company. So they actually hire former sell-siders to work for Bloomberg, and all they do is curate the analyst reports. So rather than having to have 30 analysts and read all their reports, these 2 people read them every day and post the highlights. So if you're lazy and you just want to read the summary, this is the summary of what all the analysts are talking about for a company, in this case, NVIDIA. I printed this out, and that's one of the announcements. They also do the same thing with industry research. Here's the industry primer for halfway through the year on semiconductors. I printed it out and I posted it. Okay, so that's there as well, because I don't expect you to know a lot about semiconductors, and I don't expect you to know a lot about NVIDIA. So I'm helping you by giving you real world information about the company. Okay. And then the final thing that you're likely going to want to use to do the assignment, if you have not used it before, is over here on Elms in VBIC. What the hell is VBIC? Do you guys ever use VBIC? The business school online library?
It's been a while.
Why is it not linked on here? It's really weird. All right, hold on. Let me see if I can sections, navigation. Oh, where did VBIC go? Oh, here's VBIC. I don't know why it's not enabled. All right, it's now enabled. And let me save that. Is VBIC here now? Where'd it go? Oh, update.
No.
There it is. All right, I'll figure out why it's not there and try and put it there. But just to show you quickly, because I know it's in 718, summer 24. Should be on your menu. But when you see it, click on VBIC, go to open new tab, and we have all these resources of the university online. Under industry, we subscribe to a data service called IBIS World. Anybody use it before? IBIS World does professional industry reports, right? Paid research. And if you click on IBIS World and log in, what you can do is type in a company or industry. So in your case, type in semiconductors. It'll show you the latest industry research report they wrote. I think this one's from, what was it, April. And it gives you kind of an industry analysis, including the 5 forces. So there's actually a 5 forces analysis right here in the VBIC report. Okay. And here's the point I want to make this semester. We are an academic institution, and plagiarism is frowned upon, and bad things will happen to you if you plagiarize. So you are not allowed to plagiarize, ! Right? Academic integrity. However, because of the real world nature of this class, I do expect you to use the real information to answer the real questions. So what that means, if I want to use data from VBIC, I have to bibliography VBIC. If I cut and paste in from VBIC, there better be quotes and a footnote around it. If you cut and paste and there's no quote and footnotes, then you're heading for an XF and potential expulsion. All right. But if you quote and you footnote, then that's perfectly acceptable. Okay. And I fully expect this semester you're going to have to. So it is okay, so long as you source, to summarize information that the analysts are actually talking about, because you're answering the exact same questions they're trying to figure out. All right. So this is a very real world assignment. And it's perfectly okay to use real world information and to kind of put your opinion in there, but in the context of the class. But that's going to be necessary for other assignments as well. And I just want to be really clear about what you can and can't do. Does that make sense to everybody? Because I want you to see you get in trouble. Because every assignment you go is going to be thrown in through something called Turn It In. And Turn It In is going to do a word check against people that turned in this submission in this class, as well as all those external sources. And if you're using another source, it's likely to flag it that you've used something from another source. And so if I look at what I've seen as flagged and I see footnotes and bibliography, then I'm going to say kosher. If I don't see that, then you're going to the Honor Council. And I tell you, when I send people to the Honor Council, it turns out very badly for you. So make sure you source bibliography, footnote materials. Now, I don't care what standard you use for the bibliography. Like you can say JP Morgan Analyst Report, all right, that's good enough for me, but there has to be a source. Okay, you want to do, Bartlett's quotations, fine, but I just need, a quote and a source. That's important just for the academic integrity side. Final thing I want to mention is I am allowing homework pairs this semester, which means, let's say Nathan and is it Skylar?
Skylar, yeah.
Let's say Nathan and Skylar decide they want to work as a team on this assignment. You can both turn in the assignment together for a common grade. Now, you would both have to submit the assignment as a pair. Okay, so you can't just have Nathan submit it, because if Nathan submits it and Skylar doesn't, even if you worked on it, Skylar, you're getting a 0. Okay, so you both have to submit the assignment, but here's what's important. You have to put both your names on the assignment. So I know that you're not plagiarizing somebody, you are working as a pair. Okay, so on the paper, Nathan, Skylar together, both submit it. That's okay. Now you don't have to, right? Nathan can say, I don't want to work with anybody. I want to do all the assignments myself. That's perfectly fine. But if you want to pair up with kind of a study buddy this semester, you're welcome to do so, because we're going to do a lot of work in a short period of time. Okay, so that is another acceptable thing that you could do this semester. You also need to be in teams. So make sure you sign up for teams to get your 2 points. So if you haven't put yourself in a team, you need to put yourself in a team pretty quickly. All right, we're coming to the end of our class. Questions about anything? Let's look at people. Sorry, wrong course. 758. People. Project teams. All right, I got one person. Is it Karen or Karan? Is she here? Or he? He, she? Okay, well, looks like everybody else is a team. Thank you for doing that. Easy 2 points. Yang.
Yeah, I just wanted to revisit when we took a look at TSMC earlier. I mean, it's a company that owns about 50% of the world's market in foundry, generating these types of computer chips. And I mean, I would say that based on TF5, they have a number of things that is going for them. I'm just wondering, with the ROIC being less than WACC, how could that happen? And how do they stay in business when they consistently have a WACC that's higher?
All right. Somebody tell Yang the correct answer to why what he asked was a little bit of a trap in thinking about the answer to his question. What trap is he in?
maybe I was looking in the past.
Sizing,
I gave you last year. And so last year, they didn't have a great year from an ROIC perspective. But what matters is maybe they're building these foundries that are going to allow them to do much better in the next few years. So back to SMC is what matters is not just a 1 year period, but what happens there going forward. So for example, this is in US dollars. They had 69 billion of sales. They're expected to grow to 129 billion. All right. They had EBITDA 46 billion growing to 85 billion. They had free cash flow of 10 billion growing to 36. All right. So they're spending a lot of CapEx, 30 billion a year, but they're now starting to scale up, and 30 billion on 130 billion of sales is different than 30 billion on 69 billion of sales. So I can already tell you that the ROIC is going to start to improve because the revenue is going to start growing at a much faster rate than they're investing. So the point is they're in heavy investment mode right now. And semiconductors are not cheap to begin with. I mean, it's a tough industry from an investment standpoint, which goes back to the 5 forces. Tremendous barriers to entry to this marketplace. It's not easy to get in this business. There's no one in this call that's going to start up a semiconductor fab. Like I don't know if anybody is like, the son of a trillionaire or a multi-billionaire, but nobody has $20 billion lying around to go start a foundry in Arizona. So these companies require scale, and that's the point. They're scaling up, and they're scaling up because AI needs a lot of chips in the cloud, because the cloud, that's why NVIDIA is growing so fast. Well, NVIDIA doesn't make its own chips. They need somebody to make NVIDIA's chips. I bet if I put the supply chain here, I'd be willing to bet that NVIDIA is probably one of their big customers. Customers on the right, their suppliers on the left. NVIDIA is their second biggest customer. Represents 10% of TSMC's revenue. Apple represents a quarter of their business. And Apple's trying to get, same thing, AI chips and cell phones too. So long story short, they're in heavy investment mode. So last year is dangerous to look at if you're really going to invest in them. It's data, but it's historical. I know we're 2 minutes over. Any other questions? All right, welcome to 758. Good luck with next week. If you have any questions, send me an email. Otherwise, I'll see you guys 1 week from tonight. Have a good evening.
Thank you, Professor.
Thank you.
Thank you.
Thank you, Professor.
Thank you. Bye.